Good afternoon. We'll just wait a minute for people to come in to the presentation, and then we'll get started. Still see a few people coming in here yet, so just give it another moment. Okay, it looks like we've got most everyone in the room that's joining us. Welcome, everyone. We'd like to begin by acknowledging that the CSS office, actually, Brent, I'll maybe get you to move the slide ahead. Thanks. We'd like to begin by acknowledging that the CSS office is located on the traditional lands of the Treaty 6 territory, a treaty originally signed in 1876 that includes 50 First Nations across central portions of present-day Saskatchewan and Alberta, representing the original lands of the Cree, Saulteaux, Nakota, Dene, Assiniboine, and Ojibwe peoples, and the homeland of the Métis. We extend our respect to all First Nations, Inuit, and Métis peoples for their past, present, and future stewardship of this land. And as we gather virtually from across Canada, from the many ceded and unceded, treated and untreated traditional territories, we recognize and respect the cultural diversity of First Nations, Inuit, and Métis peoples. So thank you for this opportunity to demonstrate and express CSS's support and participation in Canada's truth and reconciliation journey. Next slide, please. Okay, so let's get started. We're recording today's session, and the link to the recording will be made available in the coming days. I have a few opening remarks to make, and then the balance of today's presentation will look at updates in our member experience and investments areas. Next slide. So let me start by saying welcome to all of our members online with us today, and to those who will view this in its recorded form. I am Martin McGinnis, the Executive Director of CSS, and presenting with me today are Tammy Dove, Director of Member Experience, and Brent Godson, Director of Investments and Financial Management for the plan. And I'd also like to give a shout out to Nicole Quintal, Manager of Brand and Digital Engagement, and Fernanda Cervantes of our communications team, who put our slide deck together today for us and who are working in the background to help us with Q&A and other technical details. Tammy and Brent will be carrying the bulk of the presentation today. I'm going to start with a few overall remarks, and then I'll turn it over to them. Our intent is to leave some time at the end for Q&A, and we'd ask you to please use the chat function to enter any questions you have during the presentation. We'll do our best to answer questions live today, but if we don't get to all questions, we will ensure that we send out a complete Q&A document in the days ahead to all participants. Our expected audience today is primarily made up of CSS members who are in the retirement savings or the accumulation phase of their journey with CSS, some of whom may be approaching retirement, as well as retired members who are utilizing CSS's variable benefits product to manage their retirement income. We've learned from the feedback from members attending these State of the Plan presentations in the past that our members do have varying needs in terms of what information they expect from us. That past feedback has varied from the information being too technical to other members telling us that we were not providing enough technical information. So our goal is to try to deliver the information that you, our members, want, but we recognize that that can be difficult to do when individual members' needs vary as they do. So I wanted to mention that some members may find some of the material we present today to be a bit on the technical side, especially during the section on the plan's investments. If we do happen to miss the mark for you today, please do contact us, as we'd be more than happy to speak to you about these topics on your terms. Okay, so we've got a lot to cover today, so let's get started. Before I turn things over to Tammy and Brent, I just wanted to set things up with some overarching comments. At CSS, our overall purpose is to enable our members to achieve financial security in retirement. That means that we take a very long-term view of things. In many cases, we have members in our plan for a 30 or a 40-year career, and with any luck, another 20 or 30 or more years in retirement. So to deliver on that purpose, we need to be deliberate and focused in several key areas. And in the center of this slide are the four key focus areas of our current strategic plan. In the surrounding text boxes are a few statements about key initiatives within each of those areas. These are not intended to be exhaustive, but hopefully they give you a sense of what each of those four quadrants represent. So those four quadrants, just going around the horn here, member experience. I won't spend a lot of time talking on that here today because Tammy's going to speak to that. Leadership and innovation. So this talks about CSS ensuring that our administration and our investment management practices take advantage of modern technology, that cybersecurity and the protection of our member data is top of mind in everything we do. It also includes CSS's involvement in industry associations related to pensions and to retirement services. Next is the investments in financial management. And again, I won't spend a lot of time talking on that one because Brent's going to talk through that later in the presentation. And then the last area is growth and sustainability. And this includes things like ensuring that CSS provides a competitive and an enviable employee experience, that we've got the products and services in place that our members want to utilize both when they're accumulating in the plan, but also in retirement. And also includes things like proactively recruiting new employer members to the society and to the pension plan. In today's presentation, as I say, we'll focus on two of those key focus areas: member experience and investments in financial management. On the reflections slide, so this is reflections from 2024. And if you haven't already, I'd invite you to read the CSS annual report for 2024, which is available on our website. But I thought I'd just take a moment to highlight a few things from 2024. So as was the case in 2023, uncertainty was front and center. Weather, fire, wars, geopolitical tensions, and the like created a lot of uncertainty and volatility in the markets and in our personal lives. And this continues in 2025. Despite the challenges, we saw a strong return after expenses in our balance fund. CSS completed a comprehensive review of its overall investment portfolio in 2024. We do this every 4 to 5 years to look at the overall construction of the portfolio and then whether changes should be considered going forward. We entered the next phase of our overall member experience enhancement strategies, which included focus on the member experience that we deliver to our employer members. There's more to come in this area, but strong foundations were put in place in 2024. Member engagement and member input into what we do is very important to us. We conducted several member surveys in 2024 looking at various elements that are important to our members. We'd like to thank all of our members who responded to those, as the feedback was very insightful, and it provides us with excellent data to incorporate into the next iteration of our overall strategic plan. CSS also completed a retirement readiness assessment or study in 2024. And this looked at member outcomes, which are paramount to everything we do at CSS. So this was a future-oriented look at expected outcomes for members. So that includes the probability that a CSS member who spends their career contributing to the plan will be financially secure in retirement, as well as when, on average, members can expect to retire with that security in hand. And we were pleased to note that participation in the plan is expected to lead to a high probability of financial security in retirement, and that based on current long-term market expectations, our members can generally expect to be able to retire in their early to mid-60s. These results compare favorably to several other Canadian pension plans that we compare our performance to. So overall, an excellent result there. CSS is currently working through a complete rebuild of our pension administration system and our member portals. Having our own in-house system provides a number of strategic advantages, and it allows us to keep our administration costs low. And finally, we're very proud to be certified a great place to work again in 2024. Couple notes looking forward, what you can expect to see in 2025, 2026. We've started to turn our minds to the next iteration of our strategic plan with a target implementation in 2026. That new pension administration system and member portals I mentioned are expected to roll out in mid-2026 or so. And I do want to point out we have a changing of the guard occurring in our investments area. Brent Godson, who you'll hear from shortly, will be retiring at the end of this year. Brent's been with us since 2007 and has done yeoman service for CSS and our members during his time with us. Under Brent's watch, we've seen the pension plan assets double and the size of our membership double. Brent's been implementing a number of changes within the investment area over the past year or so to prepare the department to continue to serve our membership well in the years ahead. And we will begin the recruitment process for his replacement very soon. In the meantime, on behalf of all of us at CSS, let me take this opportunity to give a huge shout out to Brent for the very dedicated and committed service he's provided to CSS during his career with us. Brent truly has our members' best interest in mind in all that he does, and I've really appreciated having him on our team. He's definitely going to be a tough act to follow. And in the investments area, we do not see the current level of uncertainty and volatility easing in the near term. There's still a lot going on globally that's feeding that uncertainty, and Brent will comment on all things investment related in his presentation. Finally, we have a lot more planned with respect to improved member experience in the years ahead, and Tammy's going to comment on some of this in her presentation. So let me turn things over to Tammy first to provide more details in that member experience area, and then we'll have Brent take us through the investments area. So Tammy, it's all yours.
Thanks, Martin. And thank you, membership, for taking part in the emoticons. I really appreciate that engagement. That was fun. For the next 7 to 10 minutes, I'm going to invite you, remind you, engage with you about how CSS is designed to support you as you build your financial and retirement plans. Your path to financial security doesn't begin at retirement, it begins now. And CSS is here to walk that path with you. We offer tools, education, advice, guidance, and so much more. We support your financial journey through a couple different channels. There's education, like the financial and pension literacy. There's confidence building efforts so that you can feel empowered in making your own decisions. And investment management, which is developing some of those long-term pension solutions that Brent's going to be talking about here in a bit. Personally, I believe that confident, well-rounded decisions come from being informed. Now, Brent's going to be speaking more about the investment shortly, so I'm going to focus on planning and the education side of what CSS brings to you. Every step along your journey matters, and helping you have a plan and helping you learn to stick to it is a guiding light for me and my team here at CSS. From the early days of your career to transitions and well into retirement, every moment matters. That's why we're here to support you through each one of those stages. Sometimes it looks like we're giving a nudge. Other times we'll be giving guidance, some articles, some webinars, inviting you to take part in the tools that we're trying to bring to you. Life is full of changes. You know that. Your career might change. Your family situation might change. Phased retirement might happen, or retirement might happen. And that's what we're here to help you understand. Where you are now, what's coming next, and what steps you might want to consider to take now to get you to where you're going. Think of your financial journey like a hike. You don't just need a map, but you need trail markers, rest stops, and something or someone rather to walk alongside with you. I have this one member that comes to mind when I'm thinking of this journey. Now, he worked with us for 30 years, and then he chose to receive a lifetime monthly pension, and he ended up receiving it for another 40 years. That's 70 years of connection for one person. That's one of the reasons why I'm in this industry and one of the reasons why I'm here and so happy to be connected to all of our members. It wasn't just the plan, he mentioned to me, that made his retirement income possible. It wasn't just the fact that he had that retirement income. It was also the support of the advisors of people like Brent and other individuals around him who helped him understand his pension plan. It wasn't just that. It was the education, it was the relationship, and it was the support that I think CSS brings to their membership. It's a really unique, long partnership that you and I and our pension plan get to engage in. Next slide, please. What is this thing that I'm talking about? This plan? Well, when we talk about having a financial plan, it comes down to 3 core questions. Where are you going? Where am I now? And how do I get there? Depending on your personality or your situation, one of those questions might be where you start more naturally, but they all matter. I start with, where am I going? Is it retirement today? Are you thinking about retirement? Are you thinking about buying your next home, putting somebody through school, or just getting through this month's budget? Now take a moment now and reflect on that on your own. What's your goal? What's your, where am I going at this current moment? The next part in a plan is, where am I now? How stable is your income? How stable is your employment? What sort of assets do you have? How financially resilient and confident are you? And the next part, and this is the heart of your financial plan, be it a small plan or a big plan, the heart of your financial plan is, how do I get there? These are the actions, the steps, the pivots that you might have to make to get you to where are you going. Now, CSS is here to help you build that bridge from where are you going to where you are now by giving you some tools and advisors. This is all about having a plan and sticking to it. Next slide, please. We asked our members a little bit about their retirement plan confidence. First, though, we covered a little bit of this beginning pieces. A financial plan can be as simple as your monthly budget, or it can be as complex as your long-term retirement strategy. Your financial plan is going to help you manage your money, know when to save, when and where to spend. It gives you a timeline and some concrete goals that you might have in mind. It monitors your progress, and it helps you adjust and pivot. It's a tool that helps you recognize when a goal might be out of reach and how to adjust your strategy to get you back on track. We asked our pension plan members last fall, I believe. We asked them, now, how confident do they feel in their retirement or financial plan? Whether it's a written plan or just a set of actions that they're following and are in their head. Our pre-retirees, so those individuals who are early in their career, mid-career, and just before retirement, you can see there that they are showing a confidence of about 71, 74%, right? They're fairly confident in their financial plan and the actions that they're taking to get them to retirement. Our retirees, 86% of them, now they're in retirement, but they're feeling quite confident as they live their plan, as they spend wisely, as they adjust as needed, and as they make their investment or income decisions. This tells me that a plan makes a difference. A written plan is going to get you a little bit further, but a plan of any sort, in your head or written, is making a difference. It gives you that guidance, and these numbers also let me know that, of course, there's some room to help our members do more in the way of planning. Next slide. Now that we've talked a little bit about what a pension or what a financial plan is, I want to fill in some of this knowledge for you before we move on with Brent's piece. I want to focus on something that also drives a lot of what we do here, and that's called financial confidence. Alongside helping you build and stick to a plan, another North Star, I'll say, here at CSS is helping you achieve financial security in retirement. And I truly believe that the path to that security is paved with financial confidence. So how do I help you? How do we help you build your financial confidence? Well, That comes through having conversations about what a financial plan is, a retirement plan. It comes through helping you build your own personal financial literacy, pension literacy, and giving you some practical skills to help you make informed decisions. When you have the right information at the right time that is meaningful to you, you will feel capable, you will feel prepared, and you'll feel in control. That's what financial confidence is all about. Financial confidence leads to positive outcomes. So that's what's getting us to that statement of financial security in retirement. And when you are building your financial confidence, it helps you get you to that financial security in retirement. Again, though, back to my members and you guys, when we asked this question in the fall, how confident are you in your ability to achieve financial security in retirement? Of the non-retirees, because this was a question we asked just to our non-retirees, 65% said that they feel confident that they're going to achieve that goal. They're going to achieve financial security in retirement. Now, something that's really interesting about this is that's an increase over the last time that we asked this question, which was about three years ago. 2 years ago at that time, though. That growth could be linked to many things. One of that opportunities, or one of the areas that growth might be linked to, is some of the work that CSS has been bringing to you, our membership. More webinars covering your broader career, clearer education, different articles touching on different points in your journey, and access, of course, to our financial advisors. If you haven't connected with a financial planner yet here at CSS, I encourage you to. It's one of the tools that you have access to. They're here to help you build that confidence and help you move forward with clarity. My last slide. Before I pass the speaking stick on to Brent, I wanted to remind you, I started off my short session saying that I wanted to remind you or invite you to take part in the tools and the support that CSS has been building for you to build your own financial confidence and to build your own financial plan. Most of those tools exist because members, such as you, told us that you wanted them. One of the clearest messages that I heard recently was the importance of having access to financial planners. That's the bottom stat that you see there. 75% of our earlier mid-career individuals said that having access to financial planners is very important. And as you get closer to that retirement window, you're about to retire 5 to 10 years away. Well, now 80% of them are saying, we need your financial planners. We need your financial planning tools. That's why we've invested in this team of people. That's why we spent some time talking about member experience and where Martin was talking about our path forward. We want to help you understand your journey. We want to help you build a retirement plan and use the tools. I'd love to help you learn more about your pension when you are ready to learn more about your pension. Thank you for spending these few minutes with me. I hope it was 7 to 10 minutes. I lost track. As I mentioned earlier, there's another critical area that CSS focuses on in helping you achieve financial security in retirement, and that's your investments. That's this pension fund that is here to take care of your pension plan. So with that, I hand things over to Brent.
Good afternoon, everyone. I'm going to take you through the investment section of this presentation. I think for many of you that have been at the State of the Plan presentations in the past, you'll see a lot of familiarity with the information and the points that we're making. And that makes sense because our investment philosophy, our investment principles, our investment beliefs don't change over the short term. But hopefully today we can give you some more information, reinforce some of the information that we provided you in the past to help you understand why we invest the way we do. So to do that, I just have a list of things we want to try to accomplish today. We'll take a look first at 2024. What were the driving investment themes in that year? How did our performance relate to those benchmarks in that year? Then we're going to take a look at behavioral biases. We've done this in the past, but again, we think there's certain behavioral biases or human emotions that we think are important to understand and are certainly prevalent in today's market environment. Then we'll move on to give some background information on market cycles and risks. I think that's important to understand as we go through the balance of the presentation. From there, we'll dive a little bit deeper into what we think is prudent investing for our membership. We'll take a look at some of our member characteristics and how they're invested. And that'll lead us into a discussion of downside protection, how we construct portfolios for that downside protection, or in other words, to protect members from worst outcomes. From there, we'll switch gears a bit. We'll look at current market risks. What are those risks that exist in current market that may help explain some of our recent performance in recent markets? And then we'll turn our attention to how those current market risks might play out in the future by looking at long-term forecasts from one investment management firm. So let's take a look first at 2024. And 2024, we can see, was a year very much like 2023. It was one of U.S. exceptionalism. The S&P 500, the U.S. equity market, returned over 25% on the year. That was the second year in a row the market had returned over 20%. When you compare that to the rest of the world, you can see why we call it exceptionalism. The rest of the world equity market returned only 5.26%. It wasn't U.S. exceptionalism wasn't just limited to the equity market. It also extended to the U.S. dollar. The U.S. dollar versus other developed world currencies gained about 7.1%. If we drill down a little further into the leaders within the S&P 500, we can see that, again, as we've talked about before, it was this small group of large cap technology stocks, the Apples, Amazons, Metas, Googles, Teslas, and Nvidias of the world that on average returned 63% last year, where the other 493 stocks only returned 6%. Very similar to what the rest of the world equity markets returned. Within that Magnificent Seven group, Nvidia was up 172% on the year. By itself, it accounted for 22% of the S&P 500's total return. Again, a market environment where a very specific group or type of stocks outperformed. If we look at how we did in that market environment, Martin's already mentioned that our return was 8.85% a year. Under normal circumstances, that's a good absolute level of return. But when we look at what our benchmarks and how they performed at 12.38%, we're disappointed. Why had we underperformed? Well, first and foremost, we're underweight those mega cap tech stocks, that small group of stocks in the US that had returns. Secondly, our US hedging program, or our hedging program, which is positioned against the US dollar, actually underperformed as the US dollar gained relative to other developed currencies. And in general, all of our equity managers, even those outside the US, underperformed their benchmarks. So with that background information, as I mentioned, let's take a little bit of time to think about behavioral biases. Again, these are the human emotions or biases that we all experience that tend to harm our ability to build long-term wealth. And we think there's a couple in particular that are particularly relevant in today's market conditions. FOMO, where the fear of missing out is that common bias that affects investors. It's the anxiety that results from seeing other investors or savers do better than you. Think about your neighbor having bought Nvidia stock last year and earned 171%. You want a piece of that performance and that return as well. Unfortunately, the anxiety, though, can cause you to blindly invest in Nvidia or in equity markets in general without evaluating the corresponding risks and how those might impact your long-term returns. We're going to take a closer look at those risks a little bit later on in the presentation. Overall, though, we know from history that FOMO forces investors to invest at market highs, and correspondingly panic selling forces investors to sell at market lows, the exact opposite of what you want to do. And I think this study from Dalbar and chart from Dalbar emphasizes the effects of those biases. So here we have a 20-year period looking at US retail investors from 2001 to 2020. During that time frame, Dalbar found that the average US retail investor only earned 2.9% on their investments. That was slightly above inflation at 2.1%. And as you can see from looking at the slide, well below what they might have earned had they stayed invested in other investment markets. The S&P 500 index earned 7.5%. International stocks through that time period earned 5%. Bonds earned 4.8%. But again, the average investor only earned 2.9 because of that poor investor behavior. The other bias that we want to talk about or think about for this presentation is recency bias. That's the bias or the tendency for us to put too much weight on what's the latest performance trends are, while discounting other factors such as fundamentals, valuations, long-term market averages. So we think this is particularly an environment where recency bias can have a material impact on investors, because we've been in an environment where the same stocks have been winners for an extended period of time. So as this slide shows, anyone under 41 years of age has never seen non-US stocks beat US stocks for a prolonged period of time. No one under the age of 44 has ever seen value stocks beat growth stocks for a sustained period of time. And no one under 49 years of age has ever seen an investment market with long-term yields or interest rates above 5%. But again, if we look back at history, we do know that US stocks can be outperformed by non-US stocks. So as this chart shows, the blue shaded areas are where the US equities outperform. The green areas are where non-US equity outperforms. You can see that it's cyclical over time, and you can see that as early as 2000 to 2009, we had an extended period of non-US equity outperformance. Canadian equities outperformed the US, European equities outperformed, emerging markets outperformed the US equities during that time frame. And unlike today's current market of US exceptionalism, it was actually a period of US unexceptionalism. For that 10-year period, US equity markets had a slightly negative return over that full time frame. So again, things can look different than we might think by simply looking at recent return history. Similarly, if we look at value versus growth, we've shown this slide before. This slide shows the periods where value is outperforming growth are the bars above zero. The periods where growth is outperforming value are the bars below zero. We're missing 23 and 24, which were growth periods. And we can see that recently, certainly growth has been the outperformer relative to value. But if we look back over history, we see that in fact value has outperformed growth more than growth has outperformed value. And so again, these recent periods where large cap, mega cap growth in the United States has been the winner may not persist into the future based on history. So with that information in mind, we want to spend a little bit of time thinking about market cycles and risks. The point of this slide is just to, again, remind us that markets aren't one directional. That as investors, we need to be able to understand, anticipate, and withstand bear markets or down markets, as well as rising market environments. This next slide, I think, helps put market cycles a little more into perspective, and actually we'll be referring to this slide later on in the presentation as well. But as market cycles move up and down through the cycle, we can see that the point of maximum financial risk is the peak of a market cycle. We don't know when those peaks will occur in advance, but we do know that as investors approach that peak, they're at the greatest risk of financial loss, because at that point after that, market prices will fall. So we know that investors are subject to the fear of missing out in these later stages and jumping into markets without considering the risks. And we know that, of course, investors are also prone to panic selling as market prices fall. We also will talk about later the corresponding time to recovery and how that's important for our investors. One other thing we want to think about when we're talking about market cycles is that in some of these cycles, asset bubbles are forming. And when these asset bubbles form, they tend to exaggerate the height of the cycle and the depth of the loss following the cycle. Not all cycles include a market bubble, but when they do, they have some common characteristics. First of all, there's some type of displacement or innovation within the marketplace. Think of the internet example, which I have on the right-hand side of this slide. And at that time, in the mid 1990s, innovation was the internet. The internet investors saw opportunities there. They saw perceived winners. They saw perceived gains as a result of the internet, all of which eventually came true. But as investors entered the market, they drove up prices, additional media attention occurred, eventually euphoria and greed set in, driving prices to unsustainable levels. And when that happened, profit taking started, selling started, selling begat more selling, fear was introduced to the market. Again, human emotion of panic set in and drove prices even lower. So during that particular market cycle, we saw investments fall from the peak in the S&P 500 by about 49%. And the recovery in the US market in particular didn't occur until the early 2010s. So overall, we need to, again, understand the risks of bear markets. We'll talk a little bit more about them in a moment, but just to keep in mind that of the drawdowns that have occurred within the S&P 500 in the period 1945 to 2022, the average drawdown has been around 34%. The worst drawdown has been 51. The average time to recovery is 3.3 years and can be longer than that. And we'll talk about a little bit more about why that matters in a moment. So let's get into prudent investing for our membership. We're actually subject to the prudent investor rule that specifies that fiduciaries like CSS must make sound money management decision on behalf of their membership and base those decisions based on all the information that's available to them. And we're going to talk about one of the pieces of information that we actually take a close look at, and that's the demographics of our membership. Approximately 1/3 of our members are 55 plus. That's because we're quite a mature plan. We've been around for a long time. And as you might expect, if you look at the left-hand side of this slide, in the blue area of the pie chart, those members 55 and plus control about 60% of the assets of the plan. So not only they are a big population within the membership of the plan, but they control the majority of assets of the plan. And if we look at how those 55 plus members are invested, we can see that on the right-hand side of the slide, we can see that essentially they're invested in the same way as most of our members. They're invested in the balance fund. They do carry a slightly larger allocation to money market instruments. That's because our advisors generally advise members to carry a liquidity pool in the event of a bear market event, so they can draw their savings from that instead of other sources. But for the most part, they're invested like the rest of our membership. So if they're invested in the balance fund, what is the actual level of risk within the balance fund? I'm actually showing you here the balance fund at 2 points in time. Back in 2010, this was just after the financial crisis of 2008. That time we were a 60-40 traditional balance fund, 60% invested in equities. But as you can see in the pie chart, that 60% allocation to equities actually accounted for 95% of the risk in that portfolio. That amount of risk led to a 18.5% or thereabouts decline in the 2008 year. That was a significant event for our membership. Certainly for those near retirement, many were forced to extend their working years to try to recoup some of the assets they'd lost during that market. For retirees, that loss forced them to recalculate their spending decisions and reduce spending until accumulations could be rebuilt. And we know from our own membership and their behavior, many individuals exited the market during that downturn based on the same behavioral biases with the same type of results as we saw in the Dalbar study. On the right-hand side, we have our balance fund today. So good news is that through diversification in things like real estate equity, infrastructure equity, different forms of credit, emerging markets, different capitalization sizes within the equity market, we've been able to diversify away from or at least reduce the amount of equity risk that we have in the portfolio. We're now at 77%. But when we look at or test what that risk actually means in terms of expected losses, we do something called stress test and scenario tests. As Martin mentioned, we did a portfolio study last year which included those stress tests and scenario tests. And in these tests, we actually look at market environments that have happened in the past. Those are shown along the horizontal axis of this graph. And then we can model our balanced fund against those various economic scenarios to tell us what performance we might expect in those various environments. I'm going to focus on the negative environments where we see negative returns. And you can see that the one-year returns across those environments range from -4% to -20%. So we can still have a similar level of negative returns as we had within the portfolio in 2008 in a single year. Probably more importantly, though, if you look at the 5-year returns, we can see that in virtually all of those events, the 5-year returns are near zero or can be slightly negative, which means the recovery from those negative returns is also over an extended period of time. And again, we're going to talk about why that's important in just a moment. So if we look at that volatility, that risk within the balance fund, who does it impact? And for the most part, it doesn't impact pre-retirees. And this slide tries to lay that out or evidence that. So here we have 3 pre-retirees. They're in the accumulation phase, so not drawing any income. Investor A has strong returns in the early in the 5-year period that we're looking at, and then they have negative returns in years 4 and 5. Investor B has the average of those returns equally across the 5 years, and investor C has the opposite. They have the negative returns early and strong returns late. And so for each of these investors, starting out at the same $1 million investment in their accumulation, at the end of the 5-year period, they all end up at the same point, 1.274 million. They have a different path to get there, but the volatility or sequence of returns has no effect on them, provided they can withstand those behavioral biases that we talked about earlier. For our retiree group, however, or at least those close to retirement, the outcome is quite different. If we take a look at those same investors, those same return histories for over 5-year periods, same starting point, $1 million worth of investment, but now we're withdrawing or taking $60,000 of annual income over a year, you can see that the outcomes are quite different. And in fact, it's investor C that is harmed the most or has the worst outcomes. Investor C, because they've had negative returns early in their retirement experience, they've depleted their principals and are spending from their principal amount during those early years. The net effect of that is to actually deplete their retirement savings earlier than investor A and investor B. So for this group, the sequence of returns, volatility, downside risk is important. One more thing that we think about when we're looking at our membership. We do know from research, and we do know from our own experience, that retirement savers, for the change in happiness associated with a loss is much greater than an equivalent gain. And the diagram, I think, helps us understand that. So if we all have an objective that we need to get to obtain financial security in retirement, if we don't achieve that objective, the potential change in happiness for us is or can be life-changing. Alternatively, if we actually outperform or overachieve on that objective, yes, we're going to be richer, we're going to be happier, but the change in happiness just isn't quite as significant. So based on all of that information, the fact that we have this large percentage of our membership and assets in that 55 plus demographic who are exposed to sequence of return risk, who are vulnerable for down markets with long recovery periods in particular. And we know that all our retirement savings, pre-retirees and retirees, feel the pain of a loss more than the happiness of a gain of an equivalent amount. And we know that all our members are susceptible to FOMO and panic selling in market volatility events. Because of all of those things, we believe prudent investing for CSS means constructing a portfolio that protects members from the worst outcomes. One that favors protecting the portfolio from downside risks, as opposed to capturing all the returns in markets with elevated risks. So let's spend a little bit more time on what we mean by downside protection. First of all, let's get a couple of statistics out of the way, because we're going to be referencing these in some of the future slide. We want to make sure we all have an understanding of what upside capture is and what downside capture is. So both are statistical measures. Upside capture is a statistical measure that shows how your portfolio has performed when the market is moving up. The benchmark is equal to 100%. To outperform or add value to the portfolio, we need to have an upside capture greater than 100%. For example, if the S&P 500 is our benchmark and it had a 20% return in a year, our portfolio had a 25% return in the year, the upside capture ratio would be 125%, or 25 divided by 20. That would indicate outperformance in an up market. Of course, the alternative would be the case. If we're below 100%, we've underperformed the market. Downside capture is calculated the same way using the benchmark, but here, to outperform the market, we want to have a downside capture number of less than 100. For example, if the S&P 500 had a minus 20% return in a year and our portfolio had only minus 15% return, the downside capture ratio, would be 75%, or minus 15 divided by minus 20. That would indicate outperformance. So before we take a look at an example of a downside capture portfolio and how it performs over the long term, I just want to share this slide with you. I think investors are often surprised by it. But here we're looking at if our portfolio had a drawdown based on the numbers we see in orange, or the bars we see in orange on this slide, what return would we need to recover after that drawdown occurred? Those are the blue bars in the slide. So for example, if we had a minus 10% return on our portfolio, to get back to the previous high, we need to earn an 11% return. Similarly, if we had a minus 30% return on the portfolio, we need a full 43% return to get back to our previous high. And if we had an event like the great financial crisis or the internet bubble where equity markets fell around 50%, we need a full 100% return to get back to our previous high. This next slide really shows an example of a model portfolio that offers downside protection and how it would perform relative to the benchmark, the S&P 500, over long periods of time. So if we could have this hypothetical portfolio, which captures 95% of the upside market, so slightly underperforming in up markets by about 5%, but outperforming significantly in down markets by 15%. If we could create that type of portfolio over the last 80 years, from about 2017 back, that type of portfolio would have outperformed the benchmark, the S&P 500, by a factor of 3 to 1. How does it do that? If we look at the graph on the right-hand side of the slide and take a look at the shorter time frame from 1996 to 2017, a period in which we had two recessionary environments or two down markets, we can look at how that portfolio, the 95-85 portfolio, performs relative to the market. And that's the green line you see in the graph. We can see that both start equally in 1996. During normal market environments, there's a slight underperformance of that 95-85 portfolio. But when those recessionary environments happen, we can see the sharp increase in the graph line, indicating outperformance relative to the market. And again, when we're outside of those recessionary periods, we see more normal or similar performance to the market. So during that more brief time period, 20-year period between 96 and 2017, that portfolio, that 95-85% portfolio that protects on the downside, actually outperformed the S&P 500 by about 1.3 times. So how do we actually go about constructing our portfolio, our balanced fund, to offer that same type of downside protection? So first of all, we believe in diversification, and we already talked about this. We really believe diversification is a primary way to help us manage risk. It's key to preserving capital and to generating sustainable, attractive long-term returns. It may seem less effective in environments where there are concentrated top-performing markets, like the US equity market today. But more importantly, when the trend changes away from those concentrated approaches, this type of diversified portfolio is able to protect on the downside. This slide, just a little refresher before we talk more about how we actually target downside performance within our balance fund. So first of all, we've talked about this in the past. Academic research has shown us that historically, certain characteristics within stocks are able to outperform the broad market over the long term. Factors like value. Lower price stocks outperform high price stocks over the long term. Smaller stocks outperform large stocks over the long term. High quality stocks, as measured by things like return on equity and low debt ratios, outperform low quality stocks. Low volatility or low risk stocks have historically outperformed high volatility stocks. And momentum or high momentum stocks, usually indicated or similar to growth stocks and price momentum in the market, outperform low momentum stocks. if we think about those characteristics and we observe how they actually perform during down markets, we can actually build a portfolio or construct a portfolio that will outperform when markets are falling and recover faster from the trough once they begin to recover. And this slide helps us understand that. Here we're looking at recessions and recoveries in the United States from 1963 to 2019. We've broken down those recessions into the peak to trough period, if you think back to our market cycle slide, and then we've looked how they performed in the recovery phase of that market cycle. And so if we look at value at the top of the page, we can see that during these recessions, value performed in 3 out of 6 of the recessions. Overall, they added 11% of value historically. We've actually broken down the type of recession into a market bubble that we talked about before versus a shock to fundamentals, something like a COVID environment that we went through in 2020 or an oil price shock that we went through in the 1970s. You can see that value performs particularly well during the bubble markets, more similar to the broad market in a shock to fundamentals type recession. So we can go through each of the factors and how they performed, again, in the peak to trough phase of the market cycle and the recovery phase of the market cycle. And we can see that value and low volatility and quality in particular do the best in the peak to trough phase. Small cap and momentum not so good. In the recovery phase, value, quality, and small cap do very well. So momentum doesn't do well in either of those phases of down markets, and small cap and low volatility do well in only one phase. So let me show you how this works in practice. Our current US equity managers is called Scientific Beta. We can actually look at Scientific Beta and model their performance back to the internet bubble and the full cycle there, both the period leading up to early 2000 in which prices were rising and the subsequent period following when prices were falling. Scientific Beta is actually a quantitative strategy that actually targets those factors that we talked about: value, low volatility, quality, smaller size, and momentum. And you can see that this Scientific Beta portfolio in the period of rising prices in that investment environment substantially underperformed the S&P 500. So S&P 500 is in green. Scientific Beta portfolio is in blue. The net result of the performance across those few years was the S&P 500 went up 62% cumulative. The Scientific Beta portfolio only went up 41%. So a significant period of underperformance in that market environment, not too dissimilar to what we're experiencing right now. If we look, however, in the period that followed, when prices were falling from market peaks, again, green is S&P 500. It falls faster and deeper than the Scientific Beta portfolio, which still falls, but not as much. So during that period, the S&P 500 minus 47%, the Scientific Beta portfolio only minus 24%. If we look at those statistics that we just talked about, during the up part of the market, Scientific Beta's upside capture was only 66%, rather weak performance in that market. But if we look at their downside capture, it actually protected on the downside more than it missed out in the up market. Its downside capture was 51%. The net result through that full period was Scientific Beta had an 8% cumulative return, and the S&P 500 had a minus 15% cumulative return. So I think when we talk to members and explain those types of markets and the risks posed by, in particular, retirees, most would agree that this is a good strategy, certainly for retirees. But we often get skepticism from the pre-retirees. They believe a defensive strategy that protects on the downside doesn't add any value from them. In fact, it detracts value from them. But that's not the case, at least not from an historical perspective. So let's actually look at three of our equity managers. We'll actually take the scientific beta portfolio that we just looked at during that internet bubble, and we're going to model their performance all the way back to 1990, and we're going to compare it to the benchmark or the S&P 500 again. And if we take a look, again, blue is scientific beta, green is the market, and we can see that the accumulated value of the scientific beta portfolio, even with these recent periods of extreme weakness, has outperformed the market by 1.5 times. How has it done that? Well, if we look at the upside capture and downside capture numbers over that full 35-year period almost, we can see that in up markets, on average, it's kept up or just slightly below markets at 96%, but really added all the value during down markets. Let's take a look at our manager within, or one of our managers within the international equity space. Spruce Grove is actually the manager that's been in our portfolio longest. They've been in the portfolio since the late 1980s. They've actually been around since the mid 1980s. And again, Spruce Grove is in blue. The market is in green. Here we're looking at the MSCI EAFE index. Again, we can see the end result is that Spruce Grove has almost 3 times the accumulation of the market over that time frame. How has it done that? Well, if we look back, we can see that international markets actually had one of the worst asset bubbles historically. It was the Japan asset bubble. During the mid 1980s, as prices rose during that market environment, Spruce Grove underperformed by some 42% cumulatively, only to see once that bubble burst in 89 to 93, it outperformed the market by 110%. Spruce Grove did the same thing in the dot-com bubble, did the same thing in the GFC housing bubble, but it has lagged more recently in what might be an artificial intelligence bubble and in the COVID bubble in 2020 and 2021. But again, even with that underperformance, by capturing most of the upside in markets and really protecting on the downside, Spruce Grove has added 3 times the value of the broader MSCI EAFE index. Let's take a look at one more example. Here we're looking at Canadian markets, and one of our managers within the Canadian market is called QV Investors. QV actually stands for quality value, so you know which of those factors they're targeting. QV's been around since 1999. In fact, in the first year that they started, they underperformed in that tech-driven environment by 24% in a single year, only to subsequently outperform again in 2000 to 2002 by 97%. Did the same thing in the housing bubble, actually did the same thing in the COVID bubble. And again, the net result is an outperformance of, 2.5 times almost over the TSX index here in Canada. How'd they do it? Well, didn't quite keep up with markets when they're moving up, but really protected on the downside when markets do fall. So, the historical evidence shows us that this type of strategy isn't just for retirees. this is a strategy that historically has added value for all of our members, not just the retiree group. But we're all subject to periods when we can't see the other side of what's going to happen now. And we see this level of underperformance that we're experiencing. Again, those behavioral biases influence how we feel about our investments. So FOMO, we're underperforming our peers. We're underperforming others. Recency bias, the certain type of investment style that we're using simply hasn't worked recently, even though it's worked in the long term. So we're actually going to take a look in a moment at what the future might look like. And maybe that will help mitigate some of that FOMO and recency bias that we're experiencing. So just to summarize first, how do we protect members from worst outcomes? We diversify the portfolio across asset classes, across geographies, across capitalization sizes within equity markets. We engage managers who use fundamental analysis and favor stocks in their portfolio that exhibit lower valuations, better quality, lower volatility, and smaller size relative to the market. Those characteristics, again, have historically resulted in a portfolio that protects members from the full decline in markets when they occur, helps them recover faster from those declines, and outperforms markets over the long term. So let's just switch gears a bit and let's talk about current market conditions again. What risks exist today that actually warrant some level of protection? What risks exist today that maybe help explain some of the underperformance that we're experiencing in our balanced fund? So again, if we go back to that market cycle slide that we looked at earlier, that showed where the peak of a market cycle occurs, that's the point of maximum financial risk. We know that although we can't predict where that peak actually occurs, we know that prices are near or at their highest close to that peak. And so if we look at stock market prices or valuations currently and compare them to history, we should be able to gauge whether we're closer to or farther away from that peak. And this slide tries to do that. So in this slide, we're actually using price earnings ratios. So price earnings ratios are in this case, the price of all the stocks in the S&P 500 divided by their forecasted earnings. So that gives us how much an investor is willing to pay for a dollar's worth of earnings from a company. And then we can compare that again over history to what investors have been willing to pay in the past to determine where we are perhaps relative to that peak. So here in this slide, we have the dot and the number is the current P ratios for various markets around the world. The bars are the normal historic ranges of prices over the past 20 years. We only leave out the top 10% and the bottom 10% of observations through that 20 years. So the more extreme valuations. So we know the blue bars are more normalized valuations. If we're outside, we're in more extreme valuations. So we can see that in India and the US, these are the most extreme priced markets. They're well above their historical norms in somewhere in the top 10% of historical observations over the past 20 years. We also can see here that US, excluding the mega cap tech stocks that we talked about. So a lot of individuals would argue that stock or P ratios are warranted to be at high levels because those mega cap stocks are performing at such high levels, have such high profit margins, high cash flows, moats around them from competitive forces, that market valuation should be higher. But even if we exclude them, the rest of the market that was earning the 6% return that we looked at earlier, they're still valued higher than historically. The rest of the world, if we look at Japan, Asia Pacific ex-Japan, Europe, emerging markets, UK, China, are all within their more normalized ranges of observations, some a little higher, some a little lower. So I guess the conclusion from this is that the US market does look like it's priced high, certainly compared to historical observations, and maybe perhaps we're closer to a peak in US market prices than we are far away from it. Let's take a look at another couple of models to determine where valuations might be. This is called the S&P mean reversion model. We take here the S&P 500 price, inflation adjusted, and plot it back historically. The model's theory is that over time, prices revert to the mean. So by plotting the S&P 500 price over time, we can develop a trend line. That's the middle gray line here. And we can determine how far away current prices are either above the trend line or below the trend line. The red line we have here is what we call strongly overvalued, more than 2 standard deviations away from the trend. You can see that we're not in that range very often. We were in the tech bubble in early 2000. We were in the COVID bubble in 2021. Of course, prices fell 25% or thereabouts in the US market that year. But again, artificial intelligence came out in October of 2022, and prices jumped right back up to above that, into that strongly overvalued territory. The point of this model is, we can determine, again, how highly we are valued relative to history. And then secondly, how far prices might actually fall or could fall to revert to the mean. One more thing on valuations, just looking at return histories recently. If you go back and look at US equity markets over the past 200 years, the inflation adjusted return of the market has been somewhere between 6.5% and 7%. But, and that compares favorably to, or similarly to the last 25 years, where the average return has been 6.8%. But when we start to look over the last 10 years and more recently, we start to see those return levels increase. Over the last 10 years, the average return has been 9.7%. Over the last 5 years, 12.1%. And of course, we know that 2 years, we've had these high levels of return, both above 20% in 2 consecutive years. So overall, I think the conclusion would be market values in the US in particular are at very high levels, again, probably closer to a peak than they are further away from it. But valuations aren't the only risk that we have in this current market. The other risk we have is the level of market concentration. So at the end of 2024, if we look at the S&P 500, the top 10 stocks in that index accounted for 36% or almost 37% of the weight within the entire index. The other 490 stocks, only 63%. So if you think you're buying a diversified portfolio when you buy an S&P 500 index investment, it's really not. Of those top 10 stocks that account for 37% of that index, 9 are in the tech sector. Those stocks are similar or highly correlated in that they have the same type of market influences. They're susceptible to interest rates in the same way. They're susceptible to supply chains from China and the Taiwan semiconductor industry in the same way. They're affected by investor sentiment in the same way. So obviously that high level of correlation can pose risk for investors. As a significant downturn in one can potentially affect all. So, how high is that concentration level relative to history? This chart from JP Morgan helps put it in perspective. As you can see from the title, this is the highest level of concentration in the market since the 1970s, much higher than the internet bubble in 2000, much higher than the GFC crisis. One other thing that JP Morgan points out, again, these shaded areas are recessionary environments, and it's their conclusion that these recessions have historically happened quite frequently around these peak periods of stock market concentration. So, what exactly do those risks mean for future return expectations? What we've done is we've selected a forecast from Goldman Sachs. It's one of a number of forecasts that we review. This forecast is probably a little more bearish than some of the others, but we have others that are worse than this, and we do have others that are obviously better than this. But I think it puts into perspective how high market valuations and market concentration levels can affect future returns. So let's go through each of these bullet points. So first of all, the S&P 500 will deliver an annualized nominal return of 3% during the next 10 years. So that's very different than the last 10 years. Again, the last 10 years has been this period of exceptionalism where the US market has delivered 13% annualized returns. Now Goldman is saying the next 10 years are only going to deliver 3% annualized returns on average. Why is that? Well, the second bullet helps explain. We model prospective long-term equity returns as a function of 5 variables. First of all, starting absolute valuations. That's very similar to most consultants and other investment partners that we have. The higher the starting valuation, the lower the expected future return. Secondly, they look at stock market concentration levels. And of course, we just determined they are kind of at historic highs in terms of stock market concentration. And then they also look at economic contraction frequency, corporate profitability, and interest rates. Bullets 3 and 4 get more into the risk associated with market concentration. So bullet 3, our forecast would be 4% more, so it would be 7% instead of 3% if in our baseline we excluded a variable for market concentration. That, according to Goldman Sachs, ranks at the highest level in 100 years. So even worse than the JP Morgan ratio that we just looked at earlier. The fourth bullet explains why concentration matters. Our historical analysis show that it's extremely difficult for any firm to maintain high levels of sales growth and profit margin over sustained periods of time. The same issue plagues highly concentrated indexes. So here, again, we've shown evidence of this in the past, but we know historically the leaders at the beginning of a decade within the S&P 500 are rarely the leaders at the end of that decade. That's because it's extremely difficult, as Goldman mentions here, for those companies to maintain the high levels of growth that got them there and the high profit margins that got them there because of increased competition. The second last bullet, I think, is important to remind us of as well. Today's extremely high market concentration suggests the S&P 500 equal weighted benchmark. So that's where we invest equally in each of the 500 stocks, as opposed to weighting the stocks according to their weight within the market. That equal weighted index is likely to outperform the cap weighted index during the next decade by 2 to 8% per year. So here they're saying that, again, because those likely leaders of today are not likely to be the leaders of tomorrow, you're better off investing in that equal weighted benchmark because it's going to outperform the cap weighted benchmark by 2 to 8%. That's not surprising because if we look again historically over the long term, the equal weighted benchmark has outperformed the cap weighted benchmark over the long term. Finally, the last bullet, our forecast suggests equities will face stiff competition from other asset classes during the decade. Well, if your return expectation is only 3%, yes, you should be looking to other markets, other equity markets around the world, or possibly other asset classes like credit, real estate, infrastructure, those sorts of things. So what does that mean for CSS? Well, I think our balanced fund is positioned very well for a forecast like Goldman's. We know we're not as exposed to those high market valuations. We simply haven't participated when these rising prices in recent years. We know we have less US equity exposure overall than global equity markets. So that will be in our favor as well. And we know we're diversified in real estate, in infrastructure, in various forms of fixed income, which should produce more stable returns for us in the event of US equity and global market equity weakness. So I am going to end it there and pass it back to Martin for question and answers.
Thanks, Brent. Very informative. And thank you, Tammy, for the update on the member experience area. We do have a few questions in here. And maybe first, Brent, and it was an observation more than a question, but we remember just note that, and I think it had to do with the slide when you were talking about people being a certain age, not having seen certain market conditions, but just to comment about the 15% inflation in the 80s and just maybe validation or verification of the comments you were making there. Just wonder, is there anything, because they go on to talk about rates on lending and fixed term investments, and maybe just to tie into your last little bit about the diversification in asset classes. Curious if you've got any comments or any further thoughts to add there.
Well, when we talked about recency bias, we did talk about interest rates or long-term interest rates. And really those long-term interest rates are a function of inflation, right? So we aren't at, the 1980 type period of inflationary environments of 15% currently, but we do know we're in a higher inflationary environment than we were throughout most of the ever since the GFC. And those inflationary environments can ultimately affect where interest rates land, especially in the long term, and they can affect what asset classes, what types of equities, what sectors within the equity markets can be the outperformers going forward. So again, goes back to that recency discussion that we're having. The current, the future market environment might be very different than the one we've seen in the recent past.
Yep. Great. Thank you. A question actually for Tammy. We had a member just ask about options, related to moving RSP funds into the plan or other registered money into the pension plan. I wonder if maybe you can just share some thoughts on those options.
You bet. So making the decision to transfer in RSP funds is an important decision as part of your plan. You can transfer in RSP assets if you're no longer contributing to the pension plan, or if you're in a variable benefit product. You can transfer in many other types of registered products as well, other locked-in funds. A really good opportunity here is for me to say, definitely connect with one of our advisors, because they'll talk you through how to transfer in the monies and where to invest those monies if they're here, and just some of the consequences of that if you want to have some money held outside as well as inside of your pension plan.
Great, thanks. Here's a good one, Brent. Remember that I'm still in my 40s. have my investment set to 100% equity, should I be considering the balance fund because of the unstable U.S. market?
Well, we can't predict the future, but I think generally we take the view that you should set the amount of your equity exposure based on your own individual risk tolerance and preferences. But we wouldn't say 100%. We generally say combine an equity market or equity portfolio with the existing balance. In doing so, you do give yourself exposure to those other asset classes, like real estate equity, infrastructure equity, as well as all those other fixed income products, in addition to the equity market. So again, diversification, we think, is one of the ways that we mitigate risks. You may want to have higher equity exposures over the long term, but don't completely eliminate those other asset classes from your long-term plan at this point.
Great, thanks. And question about and you didn't speak about this necessarily in the presentation, but maybe you can comment on how our currency hedging is working in the current environment.
One answer, good. So, yeah, so again, what has happened in recent years is the US dollar has been strong versus all other developed currencies. That changed earlier this year and continues to be the case, that it's exhibiting weaknesses against not only the Canadian dollar, but other developed market currencies. That means those hedges that we have on are actually adding value rather than subtracting value. So that's a good thing.
Yep, good stuff. And a couple, maybe I'll tie these together because I think they do relate to some of what you were discussing. So first part is, how is AI going to help make CSS members more money and save or maintain our CSS overhead costs? So sort of two parts there. One related more to, I think, investment management. And maybe you can just comment, and I know you did, on just kind of where we are in a potential AI bubble, potentially. The second part is how is CSS going to offset Trump's tariffs and impact to our balance fund? So asking you to pull out your crystal ball, I guess, Brent, and tell us how the market's going to play out in those fronts. But maybe more generally, if you can comment on those, I don't know what you call trends,
yeah,
but go ahead. Yeah.
so I think on artificial intelligence, I think the question was, how is it going to help us improve returns?
Right.
I think we're still very early stages within the investment industry as to seeing how artificial intelligence can actually improve retirement outcomes. We do see certain investment managers, particularly in the quantitative side of things, using artificial intelligence to improve the data inputs that they're putting into their models. But again, I think it's very early stages to evidence how much improvement is possible and what we're going to see there. In terms of the plan itself, I kind of interpreted that you were asking about how might CSS internally be using artificial intelligence from an administration perspective to improve efficiency and reduce costs. And again, I think we're again early stages there, but we do anticipate a future where artificial intelligence can reduce the amount of time and effort we expend to help members, let us focus on more sophisticated types of issues for our membership, and leave the day-to-day stuff back and do that more efficiently.
Good. And don't know if you're purposely don't want to step on the Trump question.
Oh, Trump tariffs?
Yeah.
Again, we don't we don't know what's going to happen here. It's
Right.
all speculative at this point. I think it would be irresponsible to be making portfolio changes related to potential, tariffs that may exist for brief periods of time. We're monitoring with the rest of the pension industry. We'll make changes to asset allocation, as we always have, really based over longer timeframes.
Right on. Good stuff. Thanks. And maybe you can comment, there is a question or note in here with respect to the current year-to-date return on the balance fund. And maybe you can just put that in perspective in terms of how we're doing this year from your take.
Well, certainly, if I look at Q1 results, we're outperforming benchmarks. So again, a change from what we saw in recent years. Again, we did see a lot of volatility, and those Trump tariffs that we mentioned before did result in equity markets, particularly in the US, particularly across those mega tech stocks that have been in the winners in the past, caused them to fall early in the year. By and large, those have recovered here in Q2. So the extent of outperformance, I think, would be less than we had in Q1 so far here in Q2. But we're certainly keeping up with markets better than we had in previous years.
Yep. Thank you. There's a couple more. I appreciate we're bumping into time here, and I want to respect everybody's time, but I wonder if I could throw one more at you, Brent. And besides, we got a comment here, go Oilers, so that's great. And we'll get excited about that. We do have a member just asking about, so they've, a concern, and just probably ties right into the biases and things that you were talking about earlier, Brent, about moving their money when Trump was elected. So fear of, maybe not fear of missing out, but fear of loss, having moved their funds from the balance fund to money markets because of that fear. Any thoughts or in terms of what they might consider doing? And maybe this is a question both for you and for Tammy from an advisory perspective, but any thoughts you can share?
Yeah, I'll maybe take the first shot at it, and then Tammy can add to my comments. So again, we think investment tolerance is unique to each individual. But in general, uh, selling completely out of the market during those periods of fear, as we talked about in the presentation, can be detrimental to long-term returns and retirement outcomes. Having said that, there are circumstances where that may be appropriate, and I think you probably need to talk specifically to an advisor to determine your own circumstance. But generally, we would say, create a spending reserve with a portion of those funds and ride out the volatility with the rest of your assets. That's probably a more typical type of response. And again, that spending reserve would only apply to those individuals that are close or near retirement.
Yes, I would have echoed some of that. So this particular question, they did move to the money market, and they're trying to find out when they come back into the balanced fund itself. I would have them talk to an advisor and reestablish a spending reserve, and then know that that person has your retirement is still another 10, 20 years of being in the markets. So have your spending reserve for your income and know that you're going to ride through the markets a couple more times in your retirement.
And I've got one last question here, so maybe we'll just bite this one off as well. Just a question, wondering if we compare our results with other pension plans in the market, and if we do, how do we compare? Maybe Brent, you can comment on that.
We do. We have peers, primarily we're the second largest DC plan in Canada. PEP's the largest in Regina. That's the Public Employee Pension Plan, and UBC faculty at the University of British Columbia is the third largest. Those are our primary comparators. We regularly compare our performance to them. compare our asset allocations, compare our managers. We have recently been underperforming those particular plans to some degree based on differences in asset allocation, but largely because of things we talked about today. The fact that we have certain biases and downside protection that we prefer for our membership, and based on those characteristics of our members, that we do more than PEP or UBC.
Excellent. And I think that has cleared the slate of questions. So I want to thank our members that did submit the questions. That was excellent for us to dig into in more detail. And certainly want to thank everyone for joining us today and taking in the presentation. Again, a reminder that we will distribute a link to the recorded webinar if you want to watch some or all of it again. And we will be distributing a question and answer slate to all of the participants today. So once again, thank you all and have a good night. And as one of our members reminded us, go Oilers.